Cash value life insurance policy would be a policy that has a component to it that you could use throughout your lifetime and not just a death benefit. For example, a whole life contract or a variable universal life contract or a universal life or an index universal life. I know that I'm giving you too many terms, but those are all permanent policies which have a component to it that you can use basically during your lifetime as a living benefit. Now, those are all different. A variable universal life contract does have the ability to provide cash values for you, but they're not guaranteed. They're based on market performance, typically on mutual funds. A index universal life would also have cash values based on the S&P index. It could be the Russell, the Nikkei, any one of the indexes. There are a variety of different contracts that provide different investment vehicles. And it would provide you with the guarantees, but based on the guaranteed values, you would hardly find any cash value in that policy. A universal life policy would also have a cash value component to it, but based on the guaranteed values, you would hardly find any money in that contract as well. And the contract that would provide you with a significant amount of cash value based on the guarantees would be the whole life contract, which has a fixed cost of insurance rate, and those cost of insurance rates are not basically eating up your cash values as you get older and when you need those monies for your retirement supplements or other needs at later ages. So those contracts are all cash value policies, to answer your question, but it depends on what you're looking for. If you're looking for the guaranteed cash values versus the cash values that could be eaten up by your policy's cost of insurance or the market performance, then there will be significant differences between those contracts. Another thing is that a cash value whole life policy does have the guarantees, but it also has non-guaranteed values to it as well. The non-guaranteed values will come from the dividends. Now, dividends are not guaranteed to be paid, but dividends are guaranteed that once they're paid, not to be taken away. Unlike the variable universal life contract where the cash values may grow, but if there's a decline in the markets and your mutual funds are losing money, those monies that are paid to you can be taken away from you. So there's no principal guarantees in those investments. They're all principal sensitive, which makes a big difference. So cash values you can access during your lifetime. You can you can access them in a form of a policy loan, or you can simply get partial surrenders from your policy or full surrender your policy. That's how you would access cash values. There may be taxable consequences depending on how you access those monies. Those would be individual questions, and you may get some tax advice from your accountant or from your advisor individually.